there's an expectation or there's an assumption that savings accounts are still paying basically zero. And that's just flat out not true. The national average for savings accounts is 0.25%, according to the Bankrate May 10 weekly survey. So that's an average account of interest rates. And that's because, unfortunately, a lot of these big banks have savings accounts still yielding surprisingly 0.2%. There's other options out there that we're going to explore. 1-year CDs paying, in the high 4% range. But I think that this is a really, really big point that we want to drive home. It's kind of why are we having this discussion? Do you know what your cash is yielding? Because the big banks are not knocking on your door saying, hey, there's some other options here. There's a high interest money market, or maybe there's a money market fund you're interested in that you can 10x your yield. Is that something you're open to? But it's not happening. So a lot of investors are sitting in savings accounts yielding zero, and general checking accounts yielding zero, maybe 0.25. That's the national average. If you look a little bit harder out there, you can be looking at 4, sometimes maybe even 5% returns on cash-like investments.
Yeah, if you see down below, the high yield money market tends to pay, several times the national rate. Typically, that they're found at online banks and credit unions. But the overall theme of this discussion is if you could take anything away from today, it's know what your cash is yielding, and maybe get a sense of what your liquidity needs are with that cash, because I know the uncertainty of the market tends to have people stockpile their cash to a degree on the side. But if you're not pacing with inflation, like Rory mentioned earlier, you're typically losing value.
Right. Yeah, so let's talk about what we're offering, or at least the conversations we're having with clients. To what that other slide pointed to, we're going to be diversified. There's an environment to hold stocks, to hold bonds that we talked about, but also to hold fairly safe investments, whether that's for a potential emergency and you need an emergency fund as a homeowner, as a parent, or just as a consumer in today's economy, or maybe you're holding additional funds because there's a large upcoming payment, whether that's tax oriented or a large purchase or a second home or whatever that might be. That type of investment you probably want to have safe, but you probably want it yielding more than 0.25%. So there's money market savings accounts, which, Jeff, maybe you can kind of talk us through here. And then there's money market funds as well. And then lastly, there's the jumbo or a preferred money market. So here are 3 different instruments that you can look at, all of which you'll see are averaging yield significantly above that 0.25%. But you might use a combination of these or might gravitate towards ones, not without quote unquote risk that, Jeff, I think you can talk us through.
Yeah, the money market savings account typically is at a bank or a credit union or even an online institution. But these are situations where your money is FDIC insured up to $250,000. I mean, with some of the financial, the banking issues that we've seen lately, I mean, it really makes you have to question whether that $250,000 FDIC insurance even matters.
Right.
When the federal government said that we're gonna make sure everyone's made whole above and beyond that 250. So again, I with anything, as you take risk, there typically is benefits or higher returns on the other side. The money market savings account is going to be the lowest risk possible. With the money market fund, there are instruments that underlie that vehicle. Now, it is fully liquid, meaning within our client accounts, it typically is cash sweep functionality, means as cash is deposited into an account, it is invested directly in that money market fund. Mm-hmm. If cash is transferred out, it is pulled directly from that fund. There is no action that we need to take to purchase. It is simply swept in and swept out as transfers
minimal
come in
liquidity risk.
Yep. they use very low risk investments, treasuries, even CDs, even some of the investments that underlie the money market funds could potentially be FDIC insured.
And what we're seeing is yields upwards of 4.75, which is it's a nice number. You have $20,000 sitting in a money market fund. You're looking at a pretty decent return in terms of that return on cash compared to 0.25, 10,000, et cetera. So your money's working for you in that instance. The question is, how important is FDIC insurance to you? Because that's kind of the main difference between a money market fund and the money market savings account.
Yeah. And I think that the second bullet point in the money market fund is actually really important because the SEC introduced regulation which was implemented that really helped protect money market funds, because technically there could be a fluctuation for a short period of time within that money market fund, but these have become very secure, regulated structures, fully liquid. They're actually, very, very widely used across not only, brokerage firms, but retirement accounts, insurance companies. They manage their general account, and that's sort of like a money market fund.
I mean, it's our default cash investment is a money market fund at Fidelity. That's our default cash option, sweep in, sweep out. And we did do an evaluation and change the money market fund we were using last October. That one, as I said, give or take a day or two, is upwards in the 4.75 range. So it's a nice return on cash, something that's being provided throughout the course of the year.
And the only difference between the money market fund and the jumbo or preferred money market fund is typically the jumbo or preferred is going to have a minimum level of entry.
Yep.
And in many cases, that is an initial entry point. So 100,000 minimum to get in. It could be drawn down to $1 and you can always get back in. That's not the case with every institution, but from my experience, it tends to be the case, for most. But understand the process there. If you fall below whatever their minimum is at whatever institution, maybe they drop you back to that money market fund rate. Again, know what the process is. I mean, the difference between the two from our experience is about 20 basis points, but that's 20 basis points. So
that's national average on savings accounts.
Yep. There you go.
Yeah.
Well put.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.